But I want to start with one question. Have you guys heard this song called Made You Look? How many of you heard this song? Make a trainer. It's an Instagram meme. Come on, you must have heard this. So I don't want to sing it to remind you. But the point is that Professor Bakshi's role in my life as an investor when I was learning was to make me look at things I otherwise wouldn't take a look at. Some of the books I read, some of the ideas he discussed and made us look at those ideas have been very, very instrumental in taking us what Shahir Munger calls is a multidisciplinary thinker. I think Professor Bakshi's formal introduction everybody is aware of, but let me just take a minute of your time and introduce him formally as well. So Professor Bakshi is a distinguished adjunct professor of finance at Flame University, and previously he was an adjunct professor at MDI Gurgaon. Professor Bakshi has 25 years of teaching experience. Okay, not just an investor, but it's a great honor to have him as a teacher as well, who is so freely willing to share whatever he has learned with us. He also is a managing partner at ValueQuest Capital LLP. It's a SEBI-registered investment advisor. Professor Bakshi received M.Sc. Economics from LSE and Political Science and BCom honors from University of Delhi. He's also a fellow member of Institute of Chartered Accountants in India. And Professor Bakshi is also welcomed his family here to enjoy this presentation today. So, Prof, over to you.
Here, I was quite incoherent because one of my daughters who's sitting in the room was getting married. So I was high and I was dancing and I was incoherent. I don't know how incoherent I will be today, but hopefully less than what it was last year. So good evening to all of you. Again, thanks again CFA Society for inviting me here. This is my 9th talk, so I must be doing something right. So this particular session is on evolutionary biology, and it's been a very fascinating subject for me for a very long period of time. So I'm going to tell you about my journey, about how I learned about it, what I learned, what I've what I read, and how I applied some of the ideas that I picked up along the way. And I hope to inspire especially some of the young ones in the audience, those of you who are here for the first time, to have that multidisciplinary mindset and how to sort of inculcate that. Could we have the door shut, please? Seems like I'm in a temple. Okay, let's just dive deep into the subject matter. So this is one of my favorite videos that I show to my students in much larger courses. Here I have only about 1 hour and 30 minutes. So this is one of my favorite videos that I show to my students on evolution. Paradoxically, it's been shot in a mall. So she's going nowhere. She's making all this effort and she's going nowhere. And my wife says that I should do this all day. So what are the functional equivalents in business and investing? So what are we looking at? We're looking at a situation where you're making some effort, but you're not getting ahead. You're not going anywhere. Now, obviously, a lot of us feel like that in life in general, but in terms of business and investing, can you give me some examples that come to mind where you have done some effort, but you're not getting ahead? You're not getting what you wanted. You just are like that woman going up on a down escalator. Okay. So that's about a stock that you bought and it's not done anything for you. And it did a lot for a lot of people prior. And maybe it will start doing a lot of things after you sell. So what are you waiting for? We are all waiting for that. Okay, so that's a good example. Any others? Anybody wants to volunteer? The business? Okay, explain. Not going anywhere. Right. So it's the business which is sort of been obsoleted. They don't have the money to spend on network expansion. They don't have the money to buy 6G, let alone 5G, and so on and so forth, and they are being decimated by the remaining two large players in the market. So that's a good answer. And the reason why I'm saying it's a good answer because he's one of my ex-students. One of my senior most ex-students is here who's organizing. Thank you for that. So let me give you some of my examples, the ones which I have come up with. So one of them is the idea called maintenance capex. Basically the money that you spend, which you think is fixed asset, but is actually not. And this is not a lecture where I'm going to deep dive into all that because this is really about evolution. I'm basically talking about something that you call as an asset, but is not an asset. Now, what is an asset? Asset is something that will give you durable earning stream over a period of time, well beyond a single year. And Warren Buffett, many of us follow him, have studied his letters, and one of his most important decisions was to get out of the textile operations that he was invested in. And he basically recognized that it was a black hole. This is the business where he had the opportunity to spend money on new machines, which would improve productivity, less consumption of raw material, saving money on electricity. But he also figured out that if he made that investment, it doesn't stop all of his other competitors to also make the same investment, and they will all have more money in the game, but all the benefits of this investment will flow through to the buyers of textiles because it was a commodity industry which was having excess capacity, which is the usual suspect that you will find in such situations, that you spend money on something, you think you're going to improve your operations, but you're not the only one who's doing it. Everybody else has done it, and you're back to square one. The second example is a poor business which is profitable in accounting terms, but earns a very poor return on capital, where maybe bonds are yielding 7 or 8%, this business does 3 or 4%, and it is a growing business. So it requires money to grow. If you don't put money to grow, you will lose market share. If you do put money to grow, that money will be reinvested at rates of return which are so pathetic that you would have been better off putting the money in a fixed deposit in a bank. That's money down the hole, right? So you keep adding more and more money to such a business and you don't get anywhere. And Buffett said this in his various letters about the spectrum of quality, and he said that the worst business is the one that grows a lot. So growing businesses could be lousy businesses, and he gives an example of that. The textile operation was an example of that. Now, in contrast, if you have a high return on capital business, which can grow and which requires capital, that's a wonderful other end of the spectrum where you can create a lot of value. Every dollar retained in such a business will become more than $1 of incremental market value over time. Even better than that are businesses that have high returns on capital and have growth opportunities but don't require any capital for growth. So things like Google or Microsoft in their heydays, Facebook today, there are such businesses which have non-linear business models. They don't require incremental capital to grow, and they're extraordinarily profitable. So those are a different class of business. Again, I'm not going to delve into those businesses today. And then Charlie Munger also talked about there's a class of businesses where there's cash. There is no money coming in. These businesses are cash-consuming businesses. They need access to outside capital markets frequently just to run their operations. Not just to grow, but also to maintain their current operations. They need money because they are loss-making, they are cash-consuming. And we've seen a lot of those in the past, and we have them right now. And we also know the private markets and maybe public markets are also very unfriendly toward these businesses at this point in time. So they're in a soup. So you have to keep putting more and more money. So the metaphor, the analogy that I drew about the woman going up on a down escalator is actually quite common. In the world of investing, it comes in the form of inflation. Think inflation as the speed of the escalator going down. Think that your effort that you are doing is the speed of investing that you are doing is on the way up. So if, for example, you put your money in a fixed deposit which gives you 6% and inflation is 7%, then you're losing money. Paradoxically, people associate risk-free investing as bond investing, where returns are capped and fixed in nominal terms. But if inflation exceeds that return, you are guaranteed to lose money in real terms. So in that sense, it's not risk-free anymore. It's actually quite risky. So bonds which give you a fixed return, which is lower than the rate of inflation, are certain to lose money for you in the long run. When you invest in equities, at least you have a hope. You have a chance to beat inflation. And even if you go wrong in some of the bets, there are some other bets that might work out so well that would compensate for the ones that don't work out. But in a bond portfolio, which is yielding less than inflation, there is no such hope. So why am I mentioning all this? What has this all got to do with evolution? Well, there is a model called the Red Queen effect in evolutionary biology, which is exactly the same thing. Now, where does this model come from? Actually, it comes from a fairy tale. It comes from Through the Looking Glass by Lewis Carroll, the same woman who obviously, who famously also wrote Alice in Wonderland. And in Lewis Carroll's Through the Looking Glass, there is this queen who seizes Alice by the hand and drags her faster and faster on a frenzied run through the countryside. But no matter how fast they run, they always stay at the same place. Alice is puzzled and says, well, in our country, you would generally get to somewhere else if you ran very fast for a long time. And we've been doing, as we have been doing, this is a slow sort of a country. The queen responded, now here you see, it takes all the running you can do to keep in the same place. If you want to get somewhere else, you must run at least twice as fast. There's a marvelous book called Deep Simplicity. It was recommended by Charlie Munger many, many years ago. It has a passage on evolution. And it says that imagine that there is a species of frog that feeds on a species of fly. You have a predator and you have prey. And there are lots of ways in which frogs who want to eat flies and the flies who want to avoid being eaten sort of interact. Frogs might evolve longer tongues for fly catching purposes. Flies might evolve faster flight to escape. Flies might evolve an unpleasant taste or even excrete poisons that damage the frogs, and so on. Let's take one possibility. If a frog has a particularly sticky tongue, it will find it easier to catch flies. But if flies have particularly slippery bodies, they will find it easier to escape. And even if the tongue touches them. Imagine a stable situation in which a certain number of frogs live on a pond and eat a certain proportion of flies around them each year. Because of mutation, however, a newborn frog develops an extra sticky tongue. Fluke. We'll talk about flukes and the role of flukes. It will do well, this particular frog, which has just got lucky and developed an extra sticky tongue, it will do well compared to other frogs. Because genes for extra sticky tongues will spread through the frog population, because this frog will get more nutrition and it has got this mutation. It will pass on this mutated gene to his children, and because he will live longer, he'll have more children, and that's how evolution really works. At first, a larger proportion of flies get eaten, but the ones who don't get eaten will be more slippery ones. So genes for extra slipperiness will spread through the fly population. And after a while, there will be the same number of frogs on the pond as before, and the same proportion of flies will be eaten each year. So nothing happens. Everybody has gotten better, but the relative proportions of the two populations are just the same. It looks as if nothing has changed, but the frogs have got stickier tongues, generally speaking. The ones who don't have stickier tongues, they have been eliminated from the gene pool. And the flies have got more slippery bodies. No net change. Nothing really changes if you wait long enough. And we see that, those of you who commute to AeroCity or to Gurgaon would know that how happy you were when the new roads were built. But the commute times have not gone down. They go down over a while and they go back up. So nothing changes. So there is a lot to be said about the parallel that I'm drawing. It applies in many realms, and of course it also applies in the realm of investing and the world of business. So what have we just done? This is just an example of recognizing a pattern. We just looked at a pattern. And patterns are important. Shyam was talking about it. He has his own ways of thinking about patterns. He was talking about thematic investing. He has been doing this for a very long time. Everybody has their own way of thinking about patterns. And in this particular situation, what have we just done? We looked at a pattern that, somebody's making an effort but not getting anywhere. And patterns are very important in evaluating humans and businesses. And the way to think about patterns is to ask, like when you saw that girl, the woman trying to climb up, what does she remind you of and why does she remind you of it? These are two big questions to ask, because that will help you jump jurisdictional boundaries to think about similar situations in other domains, and that will turn you into an expert generalist, a multidisciplinary thinker. Because then you will be able to have a much deeper understanding of the concept, a much more applicable. These are what we call as first principles. These ideas that are there have got vast practical applications in different domains. If you're a doctor, you'll probably be giving me examples from how difficult it is to fight cancer, how cancer cells mutate and they end up spreading no matter what you do with the chemotherapy. So different domains will have different applications of the same idea, and that idea is what we call as the first principle or a mental model or whatever you call it. And again, I do whole courses on that, and I'm not going to go there. I'm only going to talk about some of the models that I have picked up along the way from just one field called evolutionary biology, and there are many, many other fields out there. So you really have to have this ability and the curiosity to sort of jump these jurisdictional boundaries and then drill deep to focus and perfect the thinking. And it's a lot of fun to do. It's a lot of fun to do. By the way, Flame University, where I teach, is a place where interdisciplinary thinking is promoted. In fact, if you look at their literature, they have wonderful, curriculum. You could be studying fine arts, you could be studying classical Indian dance, and you could be studying hardcore corporate finance in the same course. And this also gels with what Shyam was saying, that you need to interact with people who think differently from you, who come from different backgrounds, because that's how brainstorming works. Because if you brainstorm with people who think exactly the way you are, that's not brainstorming, that's just sheer leadership. So you need to have diversity in your mental models, you need to have diversity in your networks. I've already talked about this. So then there are wonderful books on this subject. This one was written by a professor in Columbia University, and he talks about the ability of the mind to shift or slip between different, similar, and same, allows generalization and pattern sensitivity. So this was an example of multidisciplinary thinking using just one model from one subject of evolutionary biology, and I discovered this subject 20 years ago, in 2004, when I came across some wonderful talks on the subject with Charlie Munger, and I devoured them. Sorry, I learned about the idea of multidisciplinary thinking in 2004, but prior to that I already discovered the famous book that I'm going to talk about. And that book, of course, is Richard Dawkins' Selfish Gene, and his other book called The Blind Watchmaker. My own journey in discovering evolutionary biology took place in 1998. This is my book, which was bought in 1998. And I discovered this book when I read a couple of transcripts of Charlie Munger's talks where he spoke about Richard Dawkins' books called The Selfish Gene. Both my girls are in the room. The elder one was 5 years old. And I was in so much love with this book that I could not stop talking about it when I read it. Every day I would talk about The Selfish Gene. So much so that both girls pretty much grew up thinking that this is the best book in the world, Selfish Gene. But that was long before Harry Potter came along. So I went back and checked my history, my purchase history in Amazon.com, because at those days there was no Amazon.in. And I noticed that I bought 13 copies in 1998, 2 copies, 1 copy, 1. These are all gifts I was giving out. As a professor, I love, sharing what I've learned, and I found this monumental. It was like a very, very exciting moment for me to learn some things, and I shared these books around with my friends and some of my students. In 2000 AGM of Berkshire Hathaway, somebody asked Charlie Munger, he talked about this book earlier, but he mentioned this book again. And he basically said that, look, Darwin has been around for a long time. Darwin theory has been around for a long time. But this book talks about explaining Darwin in a manner which has not been done before. There's an insight that he uses which has not been done before. And without that insight, you would have missed the importance of Darwin's theory. So that's the role of the selfish gene. And what was that insight? That insight was to look at the world from a gene's point of view. Not from an individual's point of view, but from the genes inside the cells of that individual. And there is a memorable quote in that book, which I reproduce it here, which basically explains it. And you can read it. It's a long one, so I'm not going to read that. They are in you and me, they created us, body and mind, and their preservation is the ultimate rationale for our existence. They've come a long way, those replicators. Now they go by the name of genes, and we are the survival machines. So anybody who's familiar with the Darwinian theory of evolution knows that we have a single common ancestor. So from there, how do we have this diversity of life? And along the way, these molecules which started replicating, they became genes, and then genes created bodies, and we are those bodies. So what basically Dawkins says in his book is that we are just machines. We are just robots. And everything that we do has been programmed by genes. So somebody asked in AGM 2000, a shareholder asked him a question about, how do you apply this? What do you make of this? Why is it so important? Why are you talking to me? I'm in an AGM of a company and you're talking about biology. And he says, well, if you look at the world of humanity, you'll find that there is a concept called practice evolution. And just as evolution has gradually developed eyes and wings and claws and behavior patterns that have worked so well to feed the animal, the human enterprise has developed behavior patterns denoted by the success and failures. So we're going to talk about success, we're going to talk about failures, we're going to talk about creative destruction, we're going to talk about extinction, we're going to talk about all the things that are very commonly associated with evolution, and we're going to use that in microeconomics and the world of business. So what are the parallels? So there are these amazing parallels between evolutionary biology and business. As I read through the book, I could immediately see remarkable parallels. I'm not the only one. Anybody who reads that book will see it. If you pick up that book, you will see the same parallels. So one of them, of course, is the idea of adaptation and survival. In both economics and evolutionary biology, adaptation and survival are critical. Just as species evolved to adapt to changing environments and better compete for limited resources, businesses must adapt their strategies and business model to survive in competitive markets. Those that fail to adapt risk being outcompeted and removed from the market. Extinction. Famous quote from Charles Darwin. It's not the strongest of the species that survives, not the most intelligent, but the one with most responsive to change. So we talk about changes. What happens when there's a lot of change in the environment? The second big parallel is that of natural selection and competition. Evolutionary biology emphasizes natural selection, where individual organisms possess advantageous traits have a higher chance of surviving and reproducing, like the frog who got an extra sticky tongue. Similarly, in economics, competition plays a crucial role. Businesses with innovative ideas, efficient processes, superior products or services have an advantage in the market and are selected by consumers as the preferred choice. The third parallel is the idea of natural selection, which is the Darwin idea, and the idea of invisible hand, which is the idea from Adam Smith. Both are based on the concept of self-regulation, where individuals or species are driven by the self-interest, selfish gene. Self-interest in running a business, selfish gene in life. Driven by their own self-interest to make decisions that benefit the whole. In the case of the invisible hand, individuals are driven by their own self-interest to make decisions that benefit the economy as a whole. In the case of natural selection, species are driven by their own self-interest to make decisions that benefit the species as a whole. Sorry, this is the... Both theories also rely on the idea of competition. In the case of invisible hand, competition between individuals drives the economy forward. In the case of natural selection, competition between species drives the evolution of species. Finally, both theories rely on the idea of adaptation. In the case of invisible hand, individuals must adapt to changing economic conditions in order to survive. In the case of natural selection, species must adapt to changing environmental conditions in order to survive. Now, in 1958, there was a famous essay written by a guy called Leonard Reed called I, Pencil. It's a wonderful essay. You should all read the essay. Small little essay. And many years later, Milton Friedman, the famous economist, he talked about it in one of the universities in England. I'm going to play that video in a minute. But basically, what this essay talks about is that there is no master planner. Individuals acting in their own self-interest while pursuing their interests, also achieving public good. Again, another book. So you must have seen, I've already talked about 4 or 5 books. There'll be more coming in. Again, what John Macmillan has written is absolutely right, I think, that there is no need for a master planner in economics, and there is none in biology. Evolution has no long-term goal. There are no long-distance target, no final perfection to serve as the criterion for selection, although human vanity cherishes the absurd notion that our species is the final goal of evolution. It isn't. The fourth idea here is that of extinction. Both creative destruction and evolution involve extinction of weaker entities. In evolutionary biology, species that cannot adapt effectively to changing conditions may become extinct. Similarly, in economics, we know what happens. You go out of business. The fifth pattern that comes across is that of variation and innovation in both. Evolution relies on genetic variation, which provides the raw material for natural selection and the emergence of new species. In economics, innovation serves a similar purpose by introducing new ideas, technologies, and business models that disrupt existing markets and create opportunities for growth. Both variation in genetics and innovation in business contribute to the process of change and evolution. And the sixth one is on timescales. In both fields, there's a notion of long-term progression. Evolutionary biology observes the gradual development of new species over millions of years, while economics tracks the advancement of industries, markets, or societies over years and decades, much shorter time spans. But nevertheless, we still need to speed up the process to notice that change. I'll talk about that in a while. Both processes involve continuous improvement and adaptation to changing conditions. Now, if you replace companies with individuals, industries with species, innovation with mutation, the death of entire industries with extinction, and creative destruction with natural selection, you'll agree there's so much to be learned from evolutionary biology, a subject that is much older than economics. And I'm not the only one, of course, who saw this connection. Anybody who reads that book will see the connection. But one guy who saw that connection and wrote about it was Paul Krugman. And he said that they are like, sister fields. They have a lot of common features. And he goes on to explain, economics is a study of those phenomena that can be understood as emerging from interactions among intelligent, self-interested individuals. Notice that there are really 4 parts to this definition. Let's read them from right to left. He goes from right to left. Economics is about what individuals do. Individuals are self-interested. The perspective power of economic theory comes from the presumption that people care about themselves. Individuals are intelligent. Obvious opportunities for gain are not neglected. $100 bills are not just lying around forever. And we are concerned with their interactions. Well, evolutionary theory is exactly the same. Except that over here, we're not talking about individuals, we're talking about genes trying to propagate to the next generation and to the next generation. So let's see how this really works. There's been a lot of abstract discussion. Now I'm going to make it more practical. So let's look at a video of how evolution actually plays out in the real world. But we speed it up a little bit, quite a bit actually, so we can notice it. Evolutionary changes by nature, by definition, are so slow that they're not going to be noticed by us, right? And therefore, therefore you need to speed up that change. So let's do that. This was a study done in Harvard Medical School, and I love this particular video. Evolution of bacteria. And by the way, I've been showing this video long before COVID came. So a lot of people who now know everything about that is to be known about the idea of mutations, they had no clue about what mutations were, before COVID-19. That what does not kill you makes you stronger. So the role of stressors is very important here. We all look at businesses which are doing well right now, but while we are investing, we should also think about how did that business do when there were stressors. And by the way, COVID-19 was a wonderful stress period during which you can make that test. Ben Graham, when he used to talk about investing in bonds, he used to tell you to think about interest coverage ratio not in this year, but in the worst year in the last 8 years. So if you had a good interest coverage ratio, no matter what happened to the revenue, no matter how much drop in margins or revenues, if you were still able to service your debt comfortably in a really bad year, from there he made that conclusion that this will continue in the future also. In some cases it won't, but it's a good algorithm to have. The things that have worked very well in the past are going to continue working in the future. That's exactly how evolution works, by the way. So we're going to talk about robust business models, the models which have capacity to suffer, the ones which can take a lot of attacks, a lot of hits on them. It could be management mistakes, it could be government intervention, it could be some environmental disaster, it could be something like a pandemic, we've all lived through that. It could be lots of things. And here, it's important to look at the survivors, the ones who have survived, the ones who have been around for a long time. And there's a concept called the Lindy effect. Many of you would be familiar with that. It applies, basically, the basic idea is that if a concept has been around for a long, long time, if a book has been in publication for a very long period of time, the likelihood that it will remain in publication is very, very high. And the reason for that is that it has got some value, which is enduring. And that same logic applies when you think about investing in certain businesses and industries. The duration, how long have you been around? How much pain you have suffered in the past? And what happened to you when that pain came? The second thing that comes across is that you saw the bacteria that was mutating, moving towards the center and mutating and becoming stronger and stronger, whereas the other ones are dying. Now, what is that big lesson that comes from that? That nature and business are pari-mutual games. Now, if you go to a casino and play roulette, then no matter how much money you put, the odds don't change. The odds are exactly the same. If the ball lands on red, you will make 36 times your money, and so on and so forth. The behavior of other players does not change your odds of success. It doesn't do anything for you because you're betting against the house. In a pari-mutual game, you're not betting against the house, you're betting against each other. And nature and biology and business are pari-mutual games. So, if during COVID-19, some businesses have gone extinct in industries where the strong players have survived, the ones who have survived have benefited, right? Because of the extinction or the death of their competitors. So it's not just the benefit that you have strength, but the weakness of your competitors that will make you stronger. So you've got to study the survivors, and you've got to study the people who did not survive. What did they have in common? Apart from bad luck, what else happened? And we'll talk about some of those things. Sorry, I have to fix this. This is number 3. I have OCD, so I got a wrong slide number. Fix that. So the third is about role of randomness and luck. Mutations are random. They're just luck. Natural selection is not random. It deliberately selects for traits that are fit for the environment. And the environment is also changing. We'll talk about that. Right now we assume the environment is static, but the environment changes, then what happens? We'll talk about that. And of course from there we derive the most famous words in the history of, in the theory of evolution, which is the idea of the survival of the fittest. If you're fit for the environment, you'll survive. So how do you think about mutations? So let's talk about business, let's talk about investing. I think innovation is analogous to mutations. In business, there are certain bets that have very large asymmetric payoffs. The max that you can lose is all the money that you put on that bet. But the upside can be several thousands of percentage. And when you combine that with the idea of risk aversion, wherein that you make only those bets which, if they go bad, will not kill you, position sizing, but they have asymmetric payoffs, then you want to seek uncertainty. You want to chase uncertainty because uncertainty is, by definition, uncertain. You don't know it will work or not. If it works, it can make you a lot of money. If it doesn't work, it can't kill you. That's a very asymmetric and favorable payoff to bet on, right? And that's exactly what happens in evolution when a mutation happens. When a favorable mutation happens, it will get selected. That gene will spread in the gene pool. If a successful business strategy, which you don't know it will work or not, let's try it out. But let's not do something so rash that if it doesn't work, it could destroy the company. Risk management layer. Chance favors the prepared mind. And all science is based on chance and accidental discoveries. All these things were not things that they were looking for. They were just discovered accidentally. And a lot of businesses have thrived on experimentation. One of my favorite tweets on Bezos is this one. What he looked like in 1998 and what he looks like in 2017. Accident is the first building block of evolution. But we are scared of uncertainty. In most of economic theory, in academic corporate finance, we associate uncertainty with risk. All those Greek letters that come about, which are basically nonsense in the view of the people who practice value investing. And I don't have to go there, you all understand that. But the idea is that you don't have to be scared about uncertainty. We are all wired to fear the downside of uncertainty, but we forget the change, creation, transformation, and innovation really show up without some measure of it. Instead of fearing and avoiding the unknown, you recognize and embrace it as the origin of possibility. You don't know. The thing is, just say, I don't know, but it's worth trying. Why? Because of the following conditions. Asymmetric payoffs. If it blows up in our face, it will not kill the company. If it works out, it can take the company to a different trajectory. And I don't know what will happen. And the size of the bet is so small, it just can't kill the company. And I want to have many such bets. The key word is possibility. And no one knows if this particular experiment will work or not work. So I'll give you an example, one famous example which I've mentioned earlier. Those of you who have attended my earlier talks would have seen this particular example, and those of you who have attended my courses, I don't know why you guys keep coming back, I keep rehashing the same thing over and over again, is from a wonderful book which is by Rory Sutherland, and I'll talk about that in a minute. But imagine that you're sitting in the boardroom of a major global drinks company, and we've been asked to produce a new product that will rival the position of Coca-Cola as the world's second most popular cold, non-alcoholic drink. The most popular happens to be Pepsi. So what do you say? So you've been asked to challenge, you're asked to displace. How would you respond? How would the MBAs respond? How would the MBAs from ISB respond? How would the MBAs from London Business School respond, from MDI Gurgaon respond, and many other places? What will they say? I think they might say something along the following lines. That we need to produce a drink that tastes nicer than Coke, that costs less than Coke, and that comes in a really big bottle so people get great value for money. Nobody is going to say, hey, let's try marketing some really expensive drink that comes in a tiny can and that tastes like kind of disgusting. Sounds weird, right? Well, we know how that story played out. And by doing so, they launched a soft drink brand that would indeed go on to become a worthy rival to Coca-Cola. This Austrian company, which is privately held, has the highest market share of any energy drink in the world, with 11.5 billion cans sold in 2022. The next company in the energy drink space is Monster Beverage, which is also a well-known company. It's also a highly profitable business. So I can at least show you the relative performance of the stock prices of Monster Beverage with Coca-Cola. Massive outperformance. So innovation is analogous to mutations. Asymmetric payoffs, if you get low downside risk, high upside potential, and if you're risk aversion, which means you manage the risk, you don't bet the company or bet the business in a single idea, which if it works can do wonders, but if it doesn't, if it blows up in your face, then you're out of business, you become extinct. When those conditions are met, you should be seeking uncertainty because these are favorable conditions. So this is the management factor. So when you're evaluating management, at least the way I think about this and the way my colleague who's also here in the room somewhere, we think about this is that we think about how reckless the management is and they think about risk. And how so we have a spectrum. On one hand, we have the reckless gamblers who will bet their, all the money and then some borrowed capital on a single idea. If it pays off, they become heroes. They get profiled in business magazines as the billionaires and all that. But if it blows up, and eventually it will blow up, because if you keep playing these kind of games over and over again, you will eventually, go out of business. So we have one on that extreme. The other extreme is I don't want to innovate because I don't know it'll work or not. I don't like uncertainty. I want a sure thing. We want to be invested with managements who are somewhere in the middle. We want to be invested with managers, apart from many other things, on this one dimension. We are looking for managements who are risk averse but not loss averse. They don't mind taking small losses in the expectation that these projects, even if one of them works out very well, can offset all the losses. So they're risk averse in the sense that they will never do anything that will compromise the solvency of the entire company, or even the not just solvency but generally the health of the company. You don't want to do anything that could massively impair. And if you look at the world around you, that's not how the world works. That's not how companies operate. Many businesses that go out of business precisely because they don't adhere to these principles. So there are these first principles that one could derive from evolution and from investing, and we know them actually. At least the ones investing are well known. The ones on evolution I just put up on the screen. There are only three conditions. If you have just these three principles explain all of life. You don't need anything else. All the mathematics, all the theories, everything in Darwin can be boiled down to just these three key principles. One, offspring resemble their parents. Characteristics are inherited and passed on from one generation to another. That process that transfers the genes from one generation to the next one is not perfect. There are mutations. We call them copying errors. But some mutations are good, most are not. The ones that are good will get selected. And the reason why they will get selected is because of three. There are more individuals born in each generation than survive to become adults and reproduce. The ones who don't have that good gene will not live long enough to have more kids. The ones who do have will end up having more kids. They will live to have more, children, and therefore they will be able to pass on that mutant gene to the next generation. So if you look at the gene pool, that gene will propagate. That gene will get selected. That gene for long beaks and sticky tongues and big feathers or what have you will get selected over a very long period of time. That's exactly how, and you don't need anything else. This is all that there is. If you were to reduce evolution just down to these 3 principles. And what are the 3 principles in investing? Well, we have only 3. That one, we should look at stocks as part ownership of a business. They are not pieces of paper to be traded on a daily basis. Shyam was mentioning this to a great degree. Number 2, you should look at market fluctuations as a friend. Don't get affected by markets. Again, Shyam made a reference to that. Make an independent judgment. Don't look at stock prices. Think value. What do you think this is worth? Make your judgments independent of what the markets are doing. Markets are going to do crazy things. Take advantage of that. Again, everybody's read this. Those of you who are in the value investing field, I'm not going to talk more about it. Third is, of course, the margin of safety. You could go wrong. And margin of safety could come from any sources. Again, the point is that if you look at all of value investing, no matter what, you could be doing bargain investing, Graham-style investing, you could be investing in high-quality businesses, you could be doing growth at a reasonable price, you could be going growth for free, you could be doing risk arbitrage, special situations. Whatever you're doing, you're at the end of, if you're doing it right, you're following these 3 principles in the end. You're looking for a margin of safety in risk arbitrage as much as you're looking for a margin of safety in quality investing, as much as you're looking for margin of safety in investing in higher quality, in bargain securities. So in bargain securities, you're looking for the gap between value and price. In qualitative investing, big part of the margin of safety could come from the quality inherent in the business and the durable competitive advantage, the qualitative factors that Shyam was referring to. In risk arbitrage, it could be the expected value table that you have calculated probabilistically, and there's a margin over there. So a while back, CFA Society invited Pulak Prasad, who is the founder of Nalanda Capital, who I think everybody's heard about him. He's one of the finest public market investors, a very low-profile person. His talk was never recorded. He doesn't allow any recordings. And so he's written this marvelous, marvelous book. And he is, of course, he loves Darwin, and he's written a book on that. And this is an absolute read for all of you. So everybody, please go and buy this book and read this book. And I can tell you it's a bit heavy on the biology part. You can skip parts of that. But the way he has connected the dots, the way he has put things together, it's wonderfully done. And he's talked about personal experiences. So a lot of things that are not known about Nalanda, what they thought about certain situations, how they evaluated that particular opportunity, what happened when stress was encountered, what kind of mistakes they made. Everything is covered. It's more like an autobiography, but he's just weaved together Darwin with his investment philosophy and talked about how it's influenced him. So you'll pick a lot of ideas from there, and the ideas that I'm talking about are there's not a lot of overlap between what he has written and what I've spoken, but there is some, and I'll make references to that over a period of time. Over a period of time means right now we are at 5 o'clock. Yeah, I'm only just warming up. Just for record, I'm on slide 66 or 123. So there are some other models that I picked up from evolutionary biology. As I mentioned, I learned about this in the 1990s, and it's been a long, long time for me. In human timescales, not evolutionary timescales. So I've picked up something. So one of them is on the idea of bacteria and growth. And the problem is, and Buffett has written about it, that bacteria tends to multiply very rapidly. And the one reason why bacteria is very good at what they do is because they reproduce very, very quickly. Some of them have a lifespan of just 10 minutes or 8 minutes. So that's literally what they do. They come, 8 minutes, it's over, and they've gone. The next one comes. And therefore, the process of mutation is massively accelerated as compared to maybe, mammals, right? So he's made a reference to this, and he basically is warning investors that be careful about growth rates. If you look at bacteria, and they multiply very rapidly. But if you look at the growth rate at which bacteria is multiplying, if you sort of extrapolate it into the future, you will find that it won't be very long when a single bacterium will become so large with its population that comes from it that it will become bigger than the sun. It never happens, right? And the reason why it never happens is something that we need to think and reflect upon, because we have to worry about growth of businesses that we are investing in and the growth rates that we plug in our very elaborate Excel models. And Pulak Prasad has completely demolished the idea of using DCF. He never uses DCF. Buffett talks about never using DCF. But DCF is the correct model to have, at least in theory, about how to value a business, present value of future cash flows. And if cash flows are growing, you'll have a higher value than if cash flows are not growing, and therefore there is a concept of growth, and you have to project that growth out somehow. So how do you think about that growth? Well, one thing to do is to be very careful about how you think about growth, because there are enemies of growth. Saturation. The sale of a hot new product can grow at astronomical rates for a time, and then everybody that cares to have one has one, and then it is only a replacement, right? So what happens when people who use your product die, and the young people don't want it? Like for me, that one big example is hair oil. How many of you use hair oil? Wow. If I had asked this question 40 years ago, I think you would be the people who raised the hand would have been in majority. And our grandparents used hair oil, and parents use hair oil. We don't use. We use shampoo and we use conditioners. And we sometimes change the color of our hair and all that stuff. But we don't use hair oil as much as our parents or grandparents did. And they've gone. So what happens to the hair oil market demand over a period of time? So we have to think about all those things, not just about saturation of the thing, but also the people who are your customers, because they are finite. They're not perpetual. And then, of course, there is competition. If it is going to become very popular, it's going to become very profitable, it's a hot new product, if the entry barriers are low, why would it not come in? The correct question to ask is, why would it not come in? What are the entry barriers? And this happens a lot. A lot of people look at some micro-cap company or a small-cap company. It's doing very well. It's gone into a business. It's developed some competency, and it's just too small, and nobody's noticing right now because it's just too small. That's why nobody's noticing. But the big guys are watching. As the target market grows bigger and you become bigger, they start noticing, and they want to be in that. And my biggest example that I've cited about this in the past in my class is that of Symphony, the air cooler company. Now, when they came, it was the world's largest air cooler company, which, by the way, doesn't still have revenues of more than $100 million. But they occupied a niche of air coolers, and they had the best air coolers in the world. And they were exporting to so many countries and so on and so forth. But because they were small, they could occupy the niche, but the niche grew. And today, if you go to Amazon.com, you'll find every Tom, Dick, Harry, Bajaj, Havells, everybody has air coolers, and they look the same. And look at the fundamental performance of Symphony. It used to be one of the highest ROE companies in the country in the appliance space. And look at the margins. So you can see what has happened over there. Competition has come in. As the category has grown, the competition has come in. There were no entry barriers. There were very low entry barriers. And then there are market share constraints. If you have 10% market share and the market is growing at 25%, a producer with a 10% share of the market, which is going at 25% per annum, while the total demand for the product is expanding at only 5% annually, by year 14, this super growth company will require 115% market share. It's not going to happen, mathematically impossible. So you can expand faster than the market only up to a point. After that, it converges. Then you have increased base. It becomes more difficult to scale. The problems of scaling. A company that sells 10 million units in year 1 can register a 40% increase in sales volume by just selling 4 million extra units in year 2. If the growth continues at the same rate, the company will have to generate 59 million unit sales to achieve 40% growth in year 10. Not going to happen, or very rare that it's going to happen. So you have to be very careful about these growth rates and what you plug in. And Graham was very careful about he was very skeptical about the idea of growth. And he was absolutely right. And we see that a lot in people who go wrong when they make judgments about value as to how to think about the growth component of value. And my way to think about growth is to appreciate it, to look for sources of it, substantial growth, but not to pay for it. So I don't want to quantify it. So for me, and by the way, when I say not to pay for it, means not to pay for it at the portfolio level. I would pay for growth, some growth in some of the individual securities that I really like, which are growing, but the valuation is not so cheap that you're getting the growth component for nothing. But I would give a sizing of that particular position such that the aggregate portfolio is priced at no growth multiple. Whatever that means, some of you don't understand that, it's okay. But that's the point, the philosophical point that I'm making is that I love growth. Even Shyam was mentioning that growth is important. Even if you're a value investor, growth is important. And you will grow into it and so on and so forth. He mentioned that, and I completely agree with him, that growth is an important component of value, but you don't have to pay for it. If you can get away without paying for it, then you don't have to quantify it. Then if you don't have to quantify it, you don't have to fool yourself into plugging into the DCF models, all those growth computations, which give you the number that you want. So it takes away a lot of the behavioral problems of making financial projections if you don't want to pay anything for growth. You just know that it's going to be big, but you just don't know how much. Aspect is the idea of cumulative advantage and compound interest. I mean, you can see they're very common. Cumulative advantage is cumulatively a certain member of a species is getting better over time. Its kids are getting better because they have longer tongues, or they have slippery tongues, or they have wings, or they have certain advantages that give them the probability of living longer and having more children, and therefore passing on their genes to the next generation. So that advantage, even if it's a tiny advantage, will accumulate over time. This exact same point is made by Pulak in his book. And he uses a single ratio to talk about this advantage. He calls it return on invested capital. And I'm not going to go into the detail of it. There are certain huge advantages of going after ROIC instead of going after margins, or even ROE, or sales growth, and so on and so forth. So I'm not going to go there, but basically he makes 4 points. And he makes the point that if you have a high return on capital, think of return on, what is return on capital? The money that you have laid out in the business and how much you're earning on that. And that money is not being paid out to you as dividend, is going back. So it's compounding internally at a given rate. Return on incremental capital is akin to compound interest formula. So he talks about the idea of compound interest inside a business. If the capital is compounding inside a business, the question is, has it been compounding? The next question is, how long will it compound? Why would it not be? Why would it not stop compounding? The entry barrier, the scalability problem, all those things come into play. But at the end of the day, the same logic, that if I can compound my money at 10.3% versus somebody else who's compounding his money at 10.1%, then over a 40-year period, the difference in terminal value will be very, very wide. And that plays out in evolution, that plays out in compound interest, that plays out in compound interest inside the business. This is what Pulak is making a point, and this is not a new point. It's been made by anybody who is familiar with investing in higher quality businesses. The third big idea that I picked up from evolutionary biology is about extreme specialization and niches. So here is another video. Organisms that have become highly specialized for a particular niche can persist over time by developing unique adaptations that optimize their success within those environments. Just occasionally, the new bacterium is endowed with some accidental advantage, mutation, such as the ability to elude or shrug off an attack or antibiotics. You only have to get lucky once. They will live and thrive on almost anything you spill, dribble, or shake loose. Just give them a little moisture, as when you run a damp cloth over a counter, and they will bloom as if created from nothing. They will eat wood, the glue in wallpaper, the metals in hardened paint. Scientists in Australia found microbes that lived in, indeed could not live without, concentrations of sulfuric acid strong enough to dissolve metal. A species was found living happily in waste tanks of nuclear reactors, gorging itself on plutonium and whatever else was there. Some bacteria break down chemical materials from which, as far as we can tell, they gain no benefit at all. They've been found living in boiling mud pots and lakes of caustic soda, deep inside rocks at the bottom of the sea, in hidden pools of icy water in Antarctica, and 11 kilometers down in the Pacific Ocean, where pressures are more than 1,000 times greater than at surface, or equivalent to being squashed beneath 50 jumbo jets. Perhaps the most extraordinary survival yet found was that of a bacterium that was recovered from sealed lenses of a camera that had stood on the moon for 2 years. So why is this important for us? Because if you occupy a niche and you become really good at it, then there is no competition. Because nobody else, for whatever reasons, we'll talk about that, can occupy that niche, because the space has been occupied. There isn't a space for another player. And it takes a lot of luck. In the case of evolution, it takes a lot of luck. In the case of business, it takes a lot of skill and luck. And Charlie Munger has made a reference to that. Just as animals flourish in niches, similarly, people who specialize in the business world and get very good because they specialize frequently find good economics that they wouldn't get any other way. They get better at what they do. So I have 2 or 3 examples from my own. My team members and I, we love niches, and we have done quite well in them. And couple of examples that come to mind. One of them is a company called CCL Products, which is a niche contract manufacturer of soluble coffee. They make coffee for customers in more than 90 countries. And once you have that scale, you're a contract manufacturer for more than 90 customers, the switching costs in that business are extraordinarily high. Firstly, you need to have that scale. If somebody tried to displace CCL, it would be very hard to do that, because they have to get 90 customers. If they get 1 customer, they don't have the scale. They don't give you that business volume, so it won't make economic sense. And even if you had that business volume, why would your customer want to switch to somebody else? Because you are selling a product which is going into the bodies of the customers of the companies to whom you are supplying this coffee, and they don't want to take a chance. So there are all sorts of reasons why the business is very successful, but they've occupied that niche. They became the world's largest contract manager. Balkrishna Industries is another example. A lot of people are familiar on this one. It doesn't make all kinds of tires. It makes just some specialized kind of tires, which are very hard to make, which require a lot of labor intensity. And they became very efficient. They became the lowest cost producer of off-road tires in the world, and they have prospered enormously over the years because they've occupied that niche, and they have grown and grown over the years and taken market share from the entrenched players over a very long period of time. There are other reasons for their success, but part of the reason is that they occupied that niche and they decide not to make all kinds of tires, but only make one kind of tires. My other favorite example about a niche business is again a case study that I do in class in some great detail, but over here I'm going to make it very short because we will run out of time, and I don't think they serve dinner. Here are 2 different cars. One of them is the Toyota, which is the world's most popular car company. They sell more cars than any other car company in the world. They make the best cars in terms of reliability and so on and so forth. And the other one is Ferrari. It's an aspirational product. Very few people can afford it. OCD comes again. This is 2000. 2 has become right. In 2022, Toyota sold 10.5 million cars. That's 28,767 cars in a day. Ferrari sold 13,000 odd cars. That's 36 cars in a day. The Toyota's daily volume is 2.2x of Ferrari's annual sales volume. But one of them is operating in a highly competitive, price-sensitive market. One of them is occupying a niche where people are completely price-sensitive. They don't care. They want to just give the money and wait for 3 years to get an allocation for the car, and the company knows it, and they say, we're going to make you wait and suffer. And the value of a car second hand is more than the value of the car first hand, and they don't jack up the price because they want to create that deprivational marketing idea. So let's not go into that. The point is that there are this niche that this company has occupied, and everybody recognizes it. Every guy wants one. Most guys I know want one if they have the money, and most girls want one of these if they have the money, right? I know some people who will sell their kidney to get one of their bags. My wife is not one of those people. She gives me that look. So you don't need a lot of customers. How many customers do you need to make money in a year? 13,000 odd customers. Somebody or the other is always getting rich. And one thing which a guy does want to buy when he becomes very rich is to buy a Ferrari. Right? It's a dream. It's a dream of a lot of kids. And they do become rich for whatever reason, stock options vesting, IPO happening, lottery, business doing well, sold a business. Something or the other is, you don't need, Ferrari doesn't need a lot of newly minted millionaires to produce the results that produce the stock price. And they have just one plant. I mean, they just make it in one country. Toyota makes it in many countries. And if you look at the returns on capital, if you look at all the things, then the stock price performance is not a fluke. This is a reflection of underlying fundamental performance of the business. So the return on capital of Toyota is in low single digits. That of Ferrari is in high double digits. So you can go on and on and on. And they have pricing power. COVID-19 came. They didn't have a blip. The only reason their sales dropped, not because the orders are cancelled, but because they couldn't make them because there was a shutdown in the plant. So it's a recession-proof business. A luxury goods company is a recession-proof business. Can you think about that? Who could have thought this? If you studied textbooks in my days, in school, in college, you would have thought that luxury goods are the goods which will get hit the most when the recession comes. Not happening. So the point I'm trying to make is that you have to keep an open mind. When you're evaluating some crazy thing that businesses are doing, you don't know it will work or not. Let it play it out. Go with the data. Let the data tell you what is working and what is not working. You don't know. You may have some preconceived notion. So you may have some preconceived notion that I'm not going to go into this crappy budget airline, but Ryanair is a crappy budget airline which is extraordinarily profitable and very, very popular, and it's the lowest provider of air travel in Europe for the longest time. And look at the stock price chart. It's not about you. It's about the customer that they are selling to. They're not selling it to you. Just because you won't buy it doesn't mean they won't buy it. So don't have this mindset, oh, that will never work. Oh, I don't like this. Oh, the product sucks. It's okay. This is just an innovation. A hotel comes up with a pricing plan that if you don't turn on the AC, we're going to charge you a lower rate. We're not going to give you towels. We're not going to give you shampoo. Get your own shampoo. We're going to cut the price by half or 30 or 40%. Will it work? A lot of people will say, this is nonsense, it's not going to work. The point I'm making is don't have those preconceived notions, because if you studied the history of innovation, some of the most things that people thought were crazy will never work, have worked brilliantly. And don't have time to talk about them, but you can do your own search and find out. So the ideas that look absolutely crazy and stupid turn out to be blockbuster ideas. So hold your judgment. Think about the principles. Asymmetric payoffs, sizing of the bet. If it doesn't pay off, no problem, you can try for another mutation. You just want the one, you just have to get lucky once. So AI Engineering was the other company I forgot to mention. Again, a foundry, but again, a wonderfully run global duopoly business. Only does high chrome grinding media, and they've done very well. So a lot of you are familiar with that company. If you look at the operating performance and the stock performance, it's there. The fourth idea that I want to talk about is the idea of camouflage. In nature, we all know about camouflage, right? We see all National Geographic channels, and we've seen a lot of this stuff.
The cuttlefish has taken camouflage to the next level.
So if you got it, you don't flaunt it, you hide it. Why would you want to hide it? Lots of reasons, right? I mean, you can speculate about the reasons. Why would you want to hide? Why would you want, supposing you're extraordinarily profitable, but have legal ways of saying that you're not as profitable as you really are. And I'll give you some examples of that. Then if some businesses take that route and they say, I'm not going to flaunt it, I want to look less profitable than I really am, why should they do that? Tax is one great example. If tax laws also allow you to competition, it will not attract attention of competitors. If you are insanely profitable and look insanely profitable, and more importantly, if you're bragging about it, you are an accident waiting to happen, especially if the entry barriers are low. But if you stay below the radar and don't talk about it and do things that will legally make you look poorer than what you really are, then you increase the durability of your ability to earn a high return over a long period of time. You increase value. So when owner earnings or economic earnings or true earnings or whatever you call it exceed owner earnings, reported earnings, it can happen because you're a drug discovery company which is charging of R&D expenses, and some of them could pay off and turn out to be blockbuster drugs. You could be a FMCG company charging of advertising and marketing expenses. You could be giving free samples which reduce the gross margin because you only charge for the paid for product. The free samples don't even enter the revenue, so the gross margin gets compressed. Many companies do that. They give free samples, or there may be other sort of moat expansion, competitive expansion outlays that you are doing, which you're all putting it through the P&L. And there are lots and lots of examples, and I've done a lot of talks on this subject. I'm not going to go there, but essentially the idea is that there are ways and means of looking poorer than what you really are. And some companies want to take that. And a big advantage for us as value investors over there, if you understand this idea, is that if you go by reported earnings, they are low, economic earnings that are high, the price is so much, the P multiple is higher than what it really is. It looks high, it looks optically expensive, it's not as expensive. So you gain a competitive advantage yourself because you're a quality investor, you're going deep dive and figuring out, is this an expense or this is an asset? How do I make the adjustments? And if you make the adjustments correctly, then you will say, well, this earns actually more than what it says it does, and therefore this is the price, and therefore it is not as expensive as it looks. I am a buyer at this price. So it gives you a competitive advantage over your peers who don't want to look at P multiples outside of databases. And another source of camouflage operating performance is I'm depicting it. I mean, any way you can look at it. This could be, a business which is capital intensive, which is doing a lot of expansion, and unit 1 is making a lot of money. The last unit is still not broken even. It could be a hospital company. It could be a theme park company. It could be so many businesses which have long gestation cycles, and they don't make money. At least the new units don't make any money. And more importantly, if they borrowed some money to build the new units, then the moment they open, the depreciation burden and the interest burden hits the P&L, right? Because you can't capitalize interest after you have gone live. So it goes through the P&L, but revenues are not there. So footfalls are not there, the revenues are not. So it's a double whammy. Suddenly the interest expense is hitting, the depreciation is hitting the P&L, and the incremental revenues are not there. So you may look at this from the point of view of ROCE. There are some units which are very high ROCE business, some are negative ROCE businesses, and there's a trajectory during which the low ROCE or negative ROCE businesses are moving towards zero and break even, and then higher ROCE. So in the aggregate and the consolidated level, it looks like a mediocre business. But inside that business are some very high ROCE businesses, and some are not so mature, and in the growth phase, low ROCE or negative ROCE business units, which because they happen to belong to this company, get consolidated, and therefore you look at the consol numbers and they don't look that impressive. So there could be something happening inside a company which is camouflaging the economic reality. And if you can see through that, that will give you an advantage. We talked about this already. The fifth point I want to leave you with is the idea that I picked up from this thing, the idea of booby traps. We see a lot of booby traps, in the animal kingdom, even in the plant kingdom. We have plants which I'll show you a video just now. Booby traps, and there are lots of booby traps in financial markets in the world of business. So you have to be very careful about booby traps. And you are a sort of a patsy in the game, as Buffett says. If you're playing poker and you don't know who the patsy is, you're the patsy. So there is a lot of incentives in capitalism to manipulate you, to take the money off you, and Charlie Munger refers to that as slaughter of the innocents. So you got to understand the human nature, that there are people on the other side who are trying to persuade you to do something, and their incentives are such that they would want to take your money and go away from there, and they sort of manipulate you into believing this is the best thing that you're going to do. So there are these booby traps, and of course we can learn a lot about booby traps. The Venus flytrap is a carnivorous plant. How did it come into existence? Same three principles: evolution. Then of course there is lion's mane jellyfish. The lion's mane jellyfish possess long flowing tentacles adorning with pulsating bioluminescent cells. This mesmerizing appearance attracts small fish and plankton which are captured by jellyfish venomous sting cells for food. You can see some of the videos. They're like quite cool to look at, so long as you are not in the ocean with them. Now, there are plenty of lion's mane jellyfish and Venus flytrap in the world of business and investing. And Shyam has, over the years, written a lot on this subject about the good guys and the bad guys, the promoters who are there to take money from you versus the promoters who treat the world as a positive sum game, and they want to make money with you, and so on and so forth. So, and so there are all these, and it's the nature of the game, that's how the world works. So there are these jellyfish and Venus flytraps in the world of business and investing, and these days some of them go by the respectable title of financial influencers. Some of them, not all of them. The sixth idea that I picked up from evolution is the idea of slack, which is a terribly important idea, because, if you look at slack, what does it mean? That you have some inefficiency in you, that you are doing something which is not needed, because, it lowers your ROC, it lowers your margin, it lowers your returns on capital, and so on and so forth. You may be sitting on excess cash. Why would you want to do that? You may have zero debt. Everybody's learned what happens when, if you have cheap debt, and if you have a higher ROA, then you can spike the return on equity with cheap debt, and you're not doing it. Or you have a variable cost structure, so if COVID comes, you can shrink. If you don't have a large fixed cost structure, or you have unutilized productive capacity, because you might get a unexpected big order from a customer and you don't have that, you can't service that customer and get pissed off and goes to somebody else who had that unutilized productive capacity. Think about this for a moment. Unutilized productive capacity is a burden on the balance sheet. It increases the denominator in the return on capital employed, but doesn't give you anything in the numerator, so long as it is unutilized. But why do you have it? And so on. You may have multiple plants, and you have a lot of customers. You may say no to a large customer because you want lower customer concentration risk, and so on. So the idea is a very simple idea. It's there in nature. Great efficiency is making us more fragile. And if you talk to the MBAs that I referenced from the three illustrious business schools, they will tell you concepts like lean manufacturing, just-in-time inventory, outsourcing. All of these things lower the denominator in ROCE. They improve the free cash flow. They increase the reported earnings, and so on and so forth. They look very nice on elaborate, Excel models and so on and so forth. But what does it do to the company or the business? They make the business more fragile. And we know this from nature. Nature likes to over-insure itself. Layers of redundancy are central risk management property of natural systems. We humans have 2 kidneys, extra spare parts, and extra capacity in many, many things. Lungs, neural system, arterial apparatus. So if one goes out, the other one is there. You can live. And Pulak has written about this. We appreciate that point very well. They are robust at multiple levels. We want our businesses to mimic the robustness of the living world, to survive and prosper in a dynamic external environment, withstand internal strategic and organizational upheavals, and evolve by taking calculated risk. Calculated risk is the same point that I was making earlier. Risk aversion, not loss aversion, willing to make bets in small projects with asymmetric payoffs. We choose to invest only in businesses that are robust at multiple levels. And again, you can read his book, and a lot of work has been done on what is robust and what is fragile. In fact, in CFA Society, I've given talks on this subject, which they will charge you money for it and they'll let you watch. Jokes. I know it's free, I'm just joking. Fitness landscape. It's an esoteric idea I discovered long back, and I've been thinking about this for a while. Let me explain this idea. It's a very, very cool idea in evolution. So here it is by R.A. Fisher. It's very mathematical. I'm not going to put up any mathematics, not that I understood it anyways. But so you're looking at a landscape, okay, where hills represent a successful evolutionary strategy and valleys represent unsuccessful strategies. Individuals are single points on a landscape. A species will be represented by a cluster of points like a flock of sheep. The sheep who are a bit higher up the slope will do better in each generation, leaving most offspring, while the ones who are lower down the slope will do worse, leaving fewer offspring. As generations pass, the little flock moves up the slope until it reaches the peak where it stays. So once you reach A, you can't get to B. The reason why you can't get to B is in an evolutionary system, you have to become worse before you get better. You have to climb down. Suppose the peak the species has evolved to is just a foothill and there are much higher peaks, that is more evolutionary advantageous stages that it could be on nearby. There is no way for a species to cross the intervening valley floor and climb those peaks, because to do so would have to first evolve to a worse or a less fitted state than the one it is already in. In effect, it has evolved up in a blind alley from which there is no escape. Now let me add another twist here. This landscape that you're looking at is not static, it's dynamic, it's shifting, it is changing. And I'll talk about the importance of this analogy in the world of business in a minute, but I'll give you one example of what I mean, a functional equivalent of what I mean. Look at what is happening in the EV space, electric vehicles. There are all these entrenched players who are wedded to ICE, internal combustion engine. They have their old way of doing business, and they're very profitable. The unit economics is superb, and now there is this new technology that has come, which is electric, vehicles, electric powered vehicles, and almost all wherever you look at it, you'll find that it's the company which was not burdened by the old way of doing things, which are prospering. Whether it is Tesla in the US or even in India, whether it is Ola, which has got this business volume, and we have Ether. You'll find that the people who are the ones who they are threatening are the ones who are sitting on A. Think about this for a moment. They already have their existing business model, they have existing relationships, they have existing, they are actually assembling these products. They have this distribution, partners, they have this ancillary sub-vendors. But this new machine doesn't need any of those things. It doesn't need gears, it doesn't need an engine, it doesn't need so many things. So to shift from A to B, they'll have to abandon. And the analogy is not absolutely perfect. What I'm trying to tell you is that it's going to be very hard. And of course, you can add in the layer from psychology about commitment bias and psychological denial that these new upstarts, they will never work, customers are never going to buy this stuff and all that, until it becomes too late for them. Tesla went and got the scale economics, and they are like 15 years ahead of all the other players. And in terms of unit economics, they make more money than any other car company in the EV space. They are losing money in the EV space. The unit economics actually sucks a lot for the existing players in the ICE who are not trying to transition into EVs. So they're going to find it very hard. Not impossible, but very hard to do that. And that's the take that I got from the idea of fitness landscape. And the idea is what happens when the terrain is rapidly shifting. Like there are earthquakes that are underneath this range of mountains. And of course, Of course, if you look at the world of business, there are some business terrains that are not shifting very rapidly and some business terrains that are shifting very, very rapidly. Semiconductors, you have on one extreme, and on the other extreme you have bricks. Buffett owns a company called Acme Bricks, largest brick making company in the United States. And they say, we make bricks which uses the same processes that were discovered in Mesopotamian days. Nothing has changed. If you look at, by the way, the oil refinery business has been around for a long time, but the business of refining oil has not really changed much. If you look at cement manufacturing, the rate of obsolescence is extraordinarily low in these businesses. In some businesses, the rate of obsolescence is extraordinarily high. The terrain is rapidly changing. And what makes sense today will not make sense tomorrow. You don't know. There's a lot of uncertainty. And Buffett has written about that. Economic terrain that is forever shifting violently is ground on which it is difficult to build a fortress-like business franchise. Such a franchise is usually the key to sustained high returns. There's no durability in it. Look at smartphones. Before Apple, there was a wonderful company called Nokia. It's gone, pretty much. And after Nokia, there was a company called BlackBerry. It's gone. And today we think Google is the most dominant search engine and ChatGPT is here. But people don't know that Google was the 21st search engine. Prior to that, there were many others. And of course, prior to Instagram, there was, and Facebook, there was, they were Orkut and a whole lot of other businesses that have been around. What made Facebook so successful? Now, I would attribute it to luck because it's completely uncertain. It has happened. Network economics is like that. People just shifted from one to the other. But the same thing that made people shift from Orkut to Facebook, how can you say that would not happen from Facebook to something else 10, 20 years from now? So the terrain, yeah? It has already happened. Okay, so I'm outdated. I'm not on Facebook, so it shows. I talked about this. Pulak has written, a robust business has high ROCE, minimal or zero debt, strong competitive advantage, fragmented customer and supplier base, stable management, and is in a slow changing industry. Slow changes mean low probability of going obsolete. Low probability of extinction, because you can fix it. Rapidly changing things, you don't know where the next mousetrap is coming from, a better mousetrap is coming from. The eighth idea, and I don't have any much slides, some 5 or 6 slides left. Learning from extinction type situation. He's thinking the rent ka time ho gaya, nikalne ka time ho gaya. More than 99% of all species that ever lived on Earth are gone, extinct. That doesn't mean new species are not coming. New species are being created by the day, but the ones which have lived 25 million years ago, and so on, they're not there now. We know that, of course. Death is the norm, survival is the exception. And in the world of nature, there are all kinds of causes of extinction. In the world of business, there are usually 2, bad luck and stupidity. So you can learn a lot from failures. Things that went belly up, things that went out of business, people who went out of business. And I call these people as my teachers because they are basically telling me that you don't have to pee on an electric fence to learn not to do it. I have a placeholder for the next guy who goes bust for the next time you call me. So how do I try to avoid extinction events for myself? So no shorting. I think Shyam was talking about FNO. I have a joke about FNO and it goes like this, that I used to live in a rented apartment and then I taught my landlord FNO trading. Now both of us live in a rented apartment. No leverage, no IPOs. Again, these are not things that I am telling you that I have discovered today. These are things that have burned me over the years and I've had near-death experiences. And somehow, because of luck of benevolence of God, I survived and I said, no more, can't pakad ke. No cash consuming businesses depending upon the kindness of strangers. Yeah, you can make money in those things, but I would rather have errors of omission than have errors of commission. And this is exactly what Pulak is saying. Just like in the living world, we forego potentially juicy opportunities if the risk of losing our capital is high. We do this by avoiding crooks and turnarounds and high debt, blah, blah. He gives a whole list, his list. One downside of this approach is we occasionally walk away from a potentially attractive investment. We are willing to live with this downside. Obviously, nature prefers errors of omission over errors of commission, because errors of commission means you're out of the gene pool. If you make a mistake before you procreate, your genes are not going to the next generation. So either don't make mistakes or procreate very early on. So that's not always possible. Another lesson is that don't fight inevitable extinction. Once in a while, you will come across invested in a business that is going to go extinct. It deserves to go extinct. The terrain has shifted. Somebody else has come up with a better mousetrap. So there are many examples. Buffett got out of textile operation. He could see the writing on the wall. Charlie Munger got out of savings and loan institutions and used the money to go and buy the very companies that are going to destroy savings and loan institutions, which at that time were Freddie Mac and Fannie Mae, which themselves blew up many years later, but long before that he had already sold them. On Daily Journal, a company which is in which he was on the board, he's still on the board, I think. And he was in the newsletter for lawyers, and the business died because of internet. He said, business is going to die, but the company will not die. And here I want to make a distinction between company and business. Company can be thought of as a living organism. And that's how Charlie Munger treated Daily Journal. He built treasury. He did not put money in the dying printing business of newsletters for foreclosure notices for lawyers all across the United States. It was a big monopoly company, very profitable. But he knew the business was going to die because internet is coming. That's happened to so many Berkshire Hathaway companies. That's happened to World Book Encyclopedia, for example. The encyclopedia business is gone. It was taken away by Microsoft Encarta. Microsoft, run by Bill Gates, friends of Warren Buffett, destroyed World Book Encyclopedia. And Encarta is gone by a so-called inferior but free thing that we use every day, almost every day, Wikipedia. So we can talk about that, time permitting. There are a whole lot of examples. But the point I'm making is that they don't fight inevitable death. It's inevitable. It's in the nature of some businesses to die, and it's also in the nature of things that in some cases you shouldn't fight it. So don't throw good money after bad. Take your money and go somewhere else, and all those things, the commitment bias and all those psychological things that people get involved in, come by. Last slide. I do think biological reasoning actually can help you investing, because I think you will frequently find the outcomes of practice evolution in companies that will point to money-making opportunities that you can't recognize by deriving them from elsewhere. Therefore, you've got to think biologically, and I think a lot of money can be made that way. Charlie Munger, thank you.
In case of investors, there are different kinds of species of investors. Some are will all die. Of course, in the biological sense, they all die, but in the professional sense, in the time that we have a passion to operate, or even individual business to operate, how do investors manage to survive and compete? And what sort of traits do investors need in different aspects? Because these are different landscapes that they operate in, and yet they have to look at all these things that you mentioned while identifying companies and building more things.
So it's the same thing that Shyam was talking about, its own evolution. Since we talk about evolution, might as well take Shyam, the air is gone.
Yes, sir.
So now I can say whatever I want. Shyam has evolved, as we saw. He's evolved, right? So that's the evolution of an investor. We all evolve. We all will go through journeys. And if we survive our evolution, then we'll get invited to such places and we'll talk about our journey. But if we don't, then we are gone in the statistics we never show. So the fact of the matter is that investors need to evolve, just like businesses need to evolve, just like species need to evolve.
And we have to use the word evolve here a little carefully. What that means is that the temptation to abandon what you think will work because it's not working right now and something else is working right now is very high in the world of investing. So, for example, if you are a hardcore quality investor, which is paying up for quality, but you would invest in cash bargains and cigar butts and all that, and that doesn't work anymore. So that's what evolution is about. That you do recognize there are some kinds of investing which are not working for probably good reason, and there are other ways of applying those very same three principles. So without abandoning those three principles of value investing, you may decide to evolve into something else. And the other reason for evolution, I'm going to take so much time answering this question, there will be no time left for the next. So
The other thing, let me narrow down this question. Because you do need to filter things, right? You do need to filter to make decisions. So can an investor narrow down with a set of checklists which are also adaptive? I don't know if the question makes sense, but the idea is to adapt even the way we look at things and not just to see things which are adapting or growing anymore. So can a checklist be created which also has the dynamic nature to adjust to different landscapes of investing?
well, I don't think the adaptive part of the checklist can be as follows. Don't invest in fraud companies, but if the stock price goes up, invest. That's adaptive, but that's wrong. So so you have to be very careful about what goes in the checklist. What goes in the checklist has to be. So checklists are very important. Of course, you know about checklists a lot more than I do because you earn so much more money and you are very much doing a process-driven sort of investing. Checklists are important, and creating those checklists are very important. They are grounded in a lot of experience. They have to be simple, they have to be brief, but they have to make sure you're not making some stupid things, do something really dumb. So they have to be very, very thoughtfully created. But once you've created them, then having some bit of adaptability in them is a good thing. But what that adaptability means, where it comes from, is very important for you to recognize and put it in the checklist.
So one thing you mentioned earlier while you were asking this question is about the survivorship of investors and also companies. Because we discuss all of these companies because they have survived, right? They became case studies eventually. So isn't this like a giant soup of survivorship bias?
Oh yeah, absolutely. So I agree with that. So I say when you talk about survivorship bias, I actually much in favor of giving into survivorship bias. So I'm talking about learning from two extremes. Look at the people who died, who went extinct. What are common things? What they did? What there any common practices or their behavior patterns that emerged that will tell you that they were peeing on electric fences and therefore I don't want to go there. So this is one thing which you can learn. The other is look at the survivors, the ones particularly those who survived for a long period of time. Think of cyclical industries, the guys who always come out ahead during down cycles. They never go bust. They're never anywhere close to insolvency. They have obviously the reason why they never do that is because they've learned it the hard way over the years, and they will not expand recklessly during good times. They will build. They'll pay off debts during good times. They will wait for dumb behavior to occur on behalf of by their own competitors, and then they will be the last man standing, so to speak. So the idea of last man standing in an industry, particularly cyclical industry, it's a survival, right? But you can see that there is a method in this pattern. The reason why he survived is not because of luck or fluke or some random mutation, but he's done it repeatedly over and over and over again. And therefore, the Lindy effect applies here. That if you've been around for a long time and you're so successful, and others, the new kids on the block, they come and go, they come and go, and they come and go, then there is something that is worth emulating. So that you can learn from, and you can learn from the other guys also who sort of grow up. So I don't think there is anything wrong in studying survivors. You can learn a lot by studying survivors.
And the opposite can also be true, right? Yeah, you can learn a lot by studying people who don't survive. There are these two books. One is Good to Great, and the other book is Good to Great to Gone, which is written by the CEO of Circuit City. Right, you're right. Yeah. So one more idea that you mentioned is quite interesting. So when you look at evolution through biological sense, to try to create an analogy for investing or business, one thing is that evolution is not in the control of the species, but in businesses or as investors, we are in some control of our evolution. Do you think that matters, and how can we channelize it?
Absolutely. So the analysis that I drew are only up to a point. You cannot say it's exactly the same. There are similarities in the two fields. There are parallels, and we can learn from that. But it's not exactly biological what we are doing, because it is a lot we do is in our control. So it's not really genes. My philosophy is not going to be. I don't think it's going to my daughters genetically, because my whatever I've learned is not going to be transferred. It can only happen through memes, not genes. By the way, the word meme was coined by Richard Dawkins, and it is there in the Self-Hate Gene book, the last chapter. He talked about meme, and that word is so popular right now. It's pretty much gone viral.
You also mentioned another thing, that somehow these timelines of investing are just of evolution of generation, right? They need some species to die, come up with a new mutation, and then keep evolving over a cycle, a different cycle. But when it comes to businesses, the time scales can be determined by the resources that they have. So in terms of animals, the resources are metabolic till they survive. But in businesses, it can be infinite. We have companies in Japan which are hundreds of years old. So these kind of energy systems, like cash is an energy system that will provide to your business fuel to try all these things. How do we look at this time scale? Because if on one side we are seeing that mutations are happening, where innovations will disrupt your business. On the other hand, we have these long gestations where you might look bad for a long period of time, yet you're surviving for the next cycle to work in your favor. How do you reconcile?
Yeah, so this question is more appropriate for somebody like Anthony Dedden, who's done exactly the same thing that we talked about, in companies in Europe, which have been around for 200 years, 150 years and all that. They have pretty much dominated their spaces. But they don't have a lot of growth, and they're mature businesses, they generate a lot of cash, you buy M.Sc from them and all that. But at the same time, there is something to be said about investing in a business which is growing and is available to get a very cheap valuation. It may not be there 50 years from now, but it's going to be there 10, 20 years from now. By the way, anybody who says they can see the world 50 years from now actually doesn't know much. Okay. So our ability to see very far out is also getting diminished because of the economic terrain that is changing very, very rapidly, and the technological changes are happening. So predictions are going to become even more difficult for us.
One is usually guaranteed of the one who is most adaptable to changes in the surrounding. But there are a lot of instances we know in business where a large giant can actually distort your ability to survive or even scale in your small niche that you're creating by either overspending or just, I would say, throwing cash at it till some of the competition vacates, either naturally or unnaturally. Yeah, how does business reconcile with that? Because there is no analogy in nature for this.
It's a bad game, it's like Gresham's law. Bad practices can drive out good practices. So somebody is doing something dumb. I think Buffett has said that you can't be a lot smarter than your dumbest competitor. If your dumbest competitor does things which will destroy the profit pool and is very well funded because they've got endless pools of capital being given to them by private equity investors, Sham is not here anymore. So. Or venture capitalist, then how do you play the game? You are in that game, you are in that. So the way to answer that is that exit the game, because it's no longer rational. But the other side is not rational, and they are deep-pocketed, and you don't know how long it can last. So exit the game, play some other game.
Another interesting idea about the fitness landscape, which came by you were explaining the chart, is that there are a lot of businesses where you see that suddenly a infusion of capital can create a lot of these upstarts. So the larger lot of what? Startups in that area where they are doing only one niche activity. Like for example, in Tesla's example, they do only one thing. They're not doing the ICE part or any other accessory that they were creating, but they were only one thing. In that case, for a survival to continue for a long period of time till everybody is right down, we haven't seen those examples truly coming up in business. Niches don't actually become very large over a period of time.
So, but to say that would never happen would be being presumptuous, because that's again like a mutation. I don't know the answer. So far, it's not happening. Yeah, so many. Every day something is happening that has never happened. I mean, we happened, right? So you were an improbable event. About 9 months before you were born, a billion sperms were racing from your dad to your mom, and only one of them made it, and that one is you. You know, 1 in a billion. Yeah, thank you.
This is a question from the audience. And then you talked about asymmetrical bets with huge payoffs, but in such a way what does not jeopardize the business. Does it? So does the martingale system fit in this criteria?
Absolutely does, and also whoever asks the question should search for the word principles of insurance underwriting in Warren Buffett letter. He's got 3 or 4 principles, exactly the same thing. Explains what it means. That I will not risk Berkshire solvency on anything, no matter how attractive it is. So you will not pull the gun if you have million chambers in it and only one of them is filled with a bullet. No matter what the payoff is, you're not going to pull the gun because the downside, no matter how improbable it is there. So he doesn't like to play those kind of games, and that's a very, very good way of thinking about it. Because in the expected value framework, if there are a million chambers, then 9999999 out of a million, you could become a millionaire, and 1 out of a million, you could be dead. So if you do probabilistic calculation, the expected value come out very high. He would play that game. He looks at worst case scenarios. If the worst case scenarios are unacceptable, don't calculate the expected returns. Don't play that game.
Well, this is the last question. I keep saying that. Yeah, because there are more questions coming in which are more interesting than what I can ask. But this is, I think, the last question now, with the shortness of time. This is a question which I also personally grapple with. I don't have an answer to it, but maybe you can. So the question says that, is it always useful to be a generalist, knowing that the world has so many different varieties of things to see? No, or can you specialize in certain niches?
We all know the story of Charlie Munger's friend who has made his billions by buying real estate in, I think, 5-mile radius around the Stanford University. That's all he has done. He specialized in becoming really good within the 5-mile radius of the Stanford University real estate. That's all that he has done as a billionaire. So you can become really, really good by saying no to almost everything and becoming very, very good at a very small thing that you like doing. For example, teaching. Awesome. Prof, thank you so much.
Thank you, Sir Director, CFA Society India, to please come to present a vote of thanks and summarize the event for us.
And first of all, it was great seeing this audience today after so long. So before we move ahead, the first session of the day today, Mr. Sanjay Bakshi, what he said is intuition develops over time, but it still needs to be educated. So I'm so happy to see all of you today investing your time and effort on a Saturday to get educated from the experience of others. So I would want only those who are in the room, those who have left need not clap, but those who are in the room, please give an ovation to all of us over here. Like I mentioned, I've got a big task list of notes over here, but I'm not going to repeat them. I'm sure you've done your own notes. So I'm just going to pick 2 or 3 points from each session that were really stellar in my opinion, but would love to hear from you in future what you felt was good about the questions. So Sanjay Bakshi, what he said, couple of things. So I've got a big list, but I'm going to pick up 2 things. There's a lot of data all around us. But what is wisdom? Wisdom is to get as much possible, as much utility possible from as little data as possible. So that is wisdom. I think that was a very important point that he made. The second speaker, of course, who is again a stellar, Mr. Sundaram, so he has also said a lot of things. But what he mentioned at the outset of his presentation was that there is a lot of buzz in the market. But most of the buzz is about external factors. But what you should also look at is internal factors which are controllable and which have to be specific to the investor who's making the investment. So I think that is one of the key takeaways from Mr. Sundaram's presentation. Again, I've got a laundry list of points out here, but I'm not going to repeat it. I'm sure these videos would be available and you would have taken your own notes as well. The third speaker that we had, again, was a stellar speaker and he's got a great reputation in the market for investments. He has actually given 4 parts of his life journey as investing. And really great to know that someone who was not even an investment manager and has run a manufacturing company for 22 odd years as a CEO has transitioned to such a stellar investment manager. So that gives a lot of inspiration to a lot of us, including me, that we can always transition careers, provided one has the curiosity to learn and to implement as well. So that was something which was great. And the last speaker, of course, we've just seen stellar pictures, such interesting concepts coming out. So personally, sir, when I see any animal or any bird or any plant I will think of you now. And what I'm going to do is, I'm going to try to apply, hey, what can I do that this guy or this chap, this ant or this bird is doing to improve my business? So that is something that is really great learning. And before I close, I promise you I'll be brief. We could not have done this event without the full efforts of volunteers. So I'm just going to read out their names so that I don't miss out any. And of course, we have the stellar volunteer Shivani over here. So we had Deepak Mundra, Gaurav Kaushik, Shivani, Pardesh, Nidhi Chauhan, and Akshay Pawar. Of course, with the able guidance of JC as we call it, are you in the room? Oh, there you are. I couldn't see you. But thank you so much for your guidance and support. And of course, to all the board members of CFA Society, Abhishek is here. And also to the institute people for the support that they've given. So I close a last round of ovation for all the volunteers who have given their time and effort to organize this for all of us, and to all of us to spend our Saturdays for learning this. Thank you.